So is the Federal Reserve worried that the economy is actually weaker than it appears, or are they just concerned of a recession in Europe, and that could be more severe than predicted? Let's ask Robert Brusca. He is the president of Fact and Opinion Economics. Robert Brusca was formerly the chief of the New York Fed's International Financial Markets Division. Always a pleasure. Thanks for coming in. All right, you said that there was a lot of news to digest out of the Federal Reserve today. Let's just start with the FOMC and the disposition of the report. Do you think that they are just worried about what's happening in the United States and we don't really understand? Or are they more concerned with Europe and there's going to be some spillover here?
Well, the truthful statement is we don't know. We can't tell from what they've told us. But very clear, the Fed has some skepticism about the recent acceleration in the economy and whether they're playing it safe because they think that there's an enhanced risk out of Europe or whether they just distrust the acceleration in the U.S. We don't know. But for policy, it all amounts to the same thing for now. They're Fed skeptical. They're not buying into the growth plan. And they're not worried about what is a pretty clear and obvious acceleration of inflation.
So if they don't buy into the growth plan and they're not worried about an acceleration of inflation and they target rates of, well, almost zero all the way to 2014, do you think people are just going to get sort of used to having low rates, and when they do move up, that's going to be a real shock to the system?
Well, that's what happened last time we had a protracted period of low rates. And when the rates did go up, they created real problems. They created problems out in Orange County, remember. There were losses, municipal bonds. One securities firm was actually driven out of business because of that.
Is that because people feel that they can actually time the Fed's moves, that they can get out before the Fed raises rates or before rates start to move up because of the health of the economy?
Well, yeah, it's a fallacy of composition. Everybody thinks that they can get out, but only some can.
So that means the exit is very crowded.
The exit gets very crowded.
So what do you think is going to happen, and what do we look for, let's say, between now and 2014? Just more of the same?
Well, and I would point out that the Fed hasn't really promised that interest rates are going to be low for that long. The Fed has simply said that, in its view, interest rates could stay low for that long a period of time. So there are other, if you took a look at the charts they released, there were a number of Federal Reserve officials who actually think that rates are going to go up this year. Three of them thought two of them thought rates go up this year. And then next year we have some that are forecasting rate increases. So when the Fed...
And that's out of the 10 voting members.
Well, that's out of the 17 who provide forecasts.
But the 10, but there aren't just 10 that vote right now, and right. 3 of the what we call hawks on the Fed, they've actually stopped voting.
Right. So the vote is among the 10. And so what happens is you don't get from the Fed what we call, you don't get an expected value result. What you get is more like the median. So if you say the interest rate is 1%, then I say it's going to be 10%, and somebody else says it's going to be 2%. Well, in the Fed view would be it's going to be 2%. So they throw away the high and the low, they take the one in the middle, right? So that's what you get. You get sort of a median result. So
sounds like the Olympics.
Right. It's like figure skating scoring, right? Don't ask me about the school figures. So but what happens is the people who are forecasting these higher rates are kind of outliers, and so their forecasts just kind of get thrown away in the process, and also they're not voting. But they're still there in the outlooks, and there's still some concern by Fed officials that rates will be going up more rapidly. So I think you want to be careful. You want to really look at what the Fed wrote. You want to look at what's there. And I think the Fed, in some ways, is trying to convince you that they're committed to having low rates for a long period of time. But to me, this doesn't help us. It doesn't make us feel better. It makes us feel worse. It makes us think that, gosh, the economy is doing better and the Fed doesn't believe it.
All right, Joe, you look like someone that swallowed the canary here. Like, you looked at the report from the FOMC. You listened to Ben Bernanke's press conference today. Is this consistent with what you've been seeing in the economy, that the Federal Reserve is on the side of caution here? They want to keep the funds flowing.
Well, the Federal Reserve did what good forward central bankers should do. They're looking right past data that they question the basic sustainability of. Second, I think what they're doing is, because of the fiscal gridlock in Washington, the Fed's the only game in town, so they're doing the least worst option. They're conditionally committing out through 2014 and even longer, telling investors that they're going to keep rates low. The hope is that we'll see an increase in fixed business investment and perhaps a little bit more hiring on the backside of this. This is an optimal policy here. This is not what the Fed wants to do, but rather it's what they have to do. And that's really the problem. What I see is long-term structural adjustment. The Fed lowered its overall growth rate. And there are even some inconsistencies here in the report that clearly signal the Fed's worried about disinflation, not inflation. And that's, for many investors, somewhat strange, given the fact that the Fed's balance sheet is close to $3 trillion.
All right, Robert, Joe mentioned this idea of conditional commitments. Is this part of that whole communication strategy that the Fed wants to talk to the market and maybe signal something, but they don't really intend to do anything?
Well, that's an interesting way to put it. But it's not really that they don't intend to do anything. It's just that
they could if they wanted to.
Well, they don't know today what they are going to intend to do, say, 1 or 2 quarters from now. When I give you a forecast today, it's conditional, as Joe says, conditional upon what I know today. And if everything I put in my forecast, more or less, I don't forecast everything, but say there are 3 or 4 variables. If they turn out to be as I forecast them, say 3 or 4 months from now, at that time, there may be other things going on that would cause me to want to act differently than I said in my forecast, even though these forecast paths came out. So this is the problem with a conditional forecast. It's always conditional upon what you know now. And it may be that in 3 or 4 months or in 6 months or a year, who's going out to 2014, right? Who knows what the Fed
can barely get through 2012, or
right,
much less through January.
Who knows what the Fed's really going to want to do? So this is the problem. You can't really see ahead. And so this is why all this scenario forecasting and these assumptions, it's important to say it's conditional. And all that means is it's the best guess we make now. And it may be, a 1-year, 2-year, a 3-year forecast, but it's still one that's made today, conditional upon what we know and think and fear today. We may fear something else by the end of the year. And inflation is accelerating, and the Fed in this meeting is not concerned about it. And I'm really concerned that the core inflation rate is moving up quite steadily, quite solidly, and the Fed just seems to feel
Why'd they take that language out? Because I was looking at your report today. You took a look at the statement today. You put it right side by side with the previous report, and you highlighted the notion that they took out the actual words having to do with inflation.
Yeah, they took out language saying that that they were going to watch inflation closely. They're not going to watch inflation closely because, like Joe said, the point is that they don't fear inflation. So they don't care what inflation does, right?
Right.
now.
Nor do I think they should. Unit labor costs are flat. Real personal disposable income's down. Real average hourly earnings are down almost 1%. The velocity of money is in a death spiral. If you're a monetary policymaker, you're looking at these data and you're thinking, I don't have a problem with inflation.
Meaning I printed a lot of money, I created a lot of money, and no one seems to want a lot of money.
And it didn't work. Yeah, essentially, we're not getting the traction.
We got $2.7 trillion on our balance sheet, and boy, we'll just park that for a while. We got a very big drawer.
That's right, and that's why they're going to this next, least worst option.
Least worst option conditional commitments. Boy, those language, that word, they're mangling the English language.
You guys, you spent way too much time in graduate school here.
I can tell. Too much information from the Federal Reserve, because we were just talking also with Robert. I want to understand this.
No.
A lot of communication. You got the 17 members, the 10 voting members. Too much?
Under normal economic conditions, I'd say probably a little too much information. But again, given the fiscal gridlock, remember Bernanke always says monetary policy is not the appropriate solution for our problems. That's fiscal solution. We're not going to get that. Therefore, we need the information. It's the best that they can do right now.
Best that they can do right now. Robert Brusca, so useless information or useful information? Too much, too little?
I think it's a little bit too much. The thing I don't like is that the Fed has switched to this dual mandate. We had for 30 years, under Paul Volcker and Alan Greenspan, we had a Fed policy that ran what I would call a reduced form monetary policy. And that is they focused on inflation, arguing that when we get inflation right, growth is as best as it can be. And Bernanke basically said that today. And making the long-term forecast, he says, look, we don't determine what long-term growth is. Well, they don't. So then why is it part of their dual mandate? I mean, that's the disconnect.
Well, is that because we've ascribed to the Federal Reserve more power than they really have?
We've given them a mandate. It's like, I'm going to give you the mandate to make me 6'5". Good luck with that, But if you've got the mandate, you're supposed to do something. What are you going to do? Maybe you're going to feed me vitamins. Maybe you're going to, try to get me some kind of crazy surgery. I don't know what you can do. But this is what happens. You give somebody a mandate that they can't do anything about. And so I think it takes the Fed's eye off the inflation ball. And I'm not convinced that if you can't do the first best thing, that the second best thing is to try to keep doing the first thing you would have done as much as you can. I think the Fed needs to look at other things, and I think that this idea that they are guaranteeing interest rates to be as low as they can for as long as they can is actually a debilitating policy that helps to kill expectations and it hurts the economy.
Joe Brusuelas, what do you think? This idea that you've got this sort of extension of low interest rates. I mean, you got a group of people who've never had anything but low interest rates right now.
Well, I know that if you're a saver or you're a member of the baby boom, that this is a very difficult time. It's what I call a rough form of generational justice. What the Fed's doing
Justice? I think you're getting crushed.
Well, I'm not getting crushed because I'm not part of the baby boomers. I think what the Fed's doing here is they're just trying to push risk-taking far out along the curve to get people out of their preferred risk habitats, which is short, risk-free U.S. Treasuries, to try to get the economy going any way they can. These guys look to me like they're more worried about deflation and about disinflation. I mean, if you look at the core PCE, it's flattened out, and it's, from my point of view, ready to start heading down, along with most other commodity prices. Once that happens, then we're going to have a pretext for the Fed to begin purchasing assets. You know, how I see this shaping up, exogenous shock from Europe, 2 to 3 months of bad consumption data, or inflation expectations move down to 1.5%, where they were when Bernanke launched the second round of large-scale asset purchases. Over the next 4 to 6 months, I think those are the barometers you want to watch.
You're just full of good news. Thank you very much.
Hey, that's why the market was up today, because those guys were expecting it.
And they got exactly what they wanted, right? All right, thank you very much. Joe Brusuelas, Bloomberg LP economist, and Robert Brusca, Fact and Opinion Economics. Thank you, gentlemen, very much.